invite the head of MMFL, Ramesh Iyer, Managing Director of M&M Financial Services Limited. Thanks, Ramesh, for joining us. Give us an idea of how the cost of money and margins are looking like for the rest of the year. Will money get cheaper as this MSF rate is cut by the Reserve Bank?
I think we are still not seeing that. Yes, 6 months back we were saying that interest possibly may come off, but what we've seen last couple of months does not give us that comfort and confidence to make that statement that interest will come off. And therefore, clearly currently the short-term funds have moved up close to 300 basis point over a period of time. And for somebody like us who's got about 10% of our borrowings coming from short-term, there is a 30 basis point impact, which of course we have negotiated with the dealers, manufacturers, and trying to push up their lending rate because we can't be wanting to absorb it all time. And we also think along with the short term over a period of time, I think one would also see maybe a 25 basis point increase even in the long term funds. So we are holding a view that interest rates are not likely to come off that very easily.
That is significant, Ramesh, and thanks for that clarity. So do I get you right? Immediately after the credit policy was announced, CP rates and CD rates came down by about 50-60 basis points. That's not very material, you're saying. It is the repo rate hike that is going to be more material?
Yeah, because it's ultimately, for a business like us, we would look for a long-term fund to stabilize and rates to come down. Because, almost all our lending is upward of 3 years lending. So, we would not want to borrow short and kind of use it for a long-term lending. And therefore, clearly one would like to see the long-term rates coming down. And for somebody like us as an enabler, the decision is between able to absorb that kind of a rate or pass it on to consumer. And we believe that the marketplace that we operate in and the product lines that we are in, we would ask for support from the manufacturers and the dealers to help us if we have not to pass it on to consumer. But I don't think we will want to absorb those kind of rate increase.
Okay. Mr. Iyer, just to focus on a couple of stats then, what is your cost of funds in Q2 as compared to Q1, and what would your NIM impact be as well?
See, clearly as I said, about 30 basis point increase one would see from a 10 to a 10.3, 10.4 kind of a level as far as overall cost of money is concerned. But we've increased also our lending rate sometime around August, end of July. And therefore we are not able to see a dip in the margin so far. But going forward, endlessly you can't increase the rate to consumer. And therefore we would look for a support, as I said, from the manufacturer and dealers. They will possibly look at it as a marketing support rather than subvention just for the sake of rate.
So you would your spread would be at that 9.6%?
I would think so. We are not forecasting a dip in the net interest margins.
Okay. What about loan growth then? Obviously at higher levels, appetite could be under strain.
If you look at this quarter alone, I mean, for us, fortunately, product mix helps us. Like tractors have done well. So, if a product is not doing well, something else comes in and does well. We have done fair amount of second-hand vehicle financing, that's the UVs and cars in the second-hand vehicle segment. So, again, we have ensured that our product mix is taking care of the growth requirement rather than focusing on one product. But I must tell you that in this quarter, one did see for new vehicle demand coming down a little, but I think all expectations are for the festival season in October, November. So one can see once more a push-up happening maybe in the third quarter of this year. And if some indications from the festival in Maharashtra or a festival in Kerala, we did see some number movement while not very significant. But clearly Dussehra, Diwali are two big festivals with good monsoon, expected good crop, maybe good support price. So the overall rural cash flow expected to hold on well. I think all hopes waiting to see what happens in the festival season of October, November.
Okay. Actually, you are more rural than any other company we can speak with, Ramesh. There is so much of positivity around the good monsoon. Are you at all seeing any improvement in demand?
As I said, tractor is one clear indicator of how the demand moved up right from pre-monsoon expectation of the monsoon likely to be good. And we saw it all through April to almost up to July when the season ended. And we do see already inquiry levels, as talking to various dealers across the country, to our own teams across the country. I think we are seeing a lot of positive sentiments, and which is why I'm saying October, November, one would clearly see large numbers coming from those markets as compared to maybe the urban center. And as I said, good monsoon, good crop, good yield, and all put together, we'll see a good festival season.
Okay. Mr. Iyer, what about asset quality in such an environment then? Is there any pressure on the CV segment, especially something which was highlighted earlier? And for example, any sort of delay in payments, etc. that you're seeing?
And hence any higher provisioning?
See, clearly if you look at commercial vehicle segment, my guess is it will continue to kind of go through this kind of quality problems for even next 6-8 months, maybe 10 months, because there's not too much of action happening around that, not too many projects, so the tippers utilization, or for that matter goods movement or whatever. So commercial vehicle will go through that little pressure. But again, coming back to the rural market, even in this quarter, in spite of monsoons, one is continuing to see average cash flow situations, and rural is clearly a seasonal market. The first half will always see a little movement upward of the NPA, and then it starts correcting no sooner the harvest is out in October, November. So if the demand is going to be high for the same reasons of good monsoon, I think the cash flows will also be equally exciting, and one would not see any inching up of NPAs during this period. But on the commercial vehicle front, we have a very small exposure, but I want to tell you that that industry is going through a difficult time, and one would continue to see that kind of a situation prevailing for another 6-8 months period.
I want to ask you a slightly difficult question. In these moving times it could be tough. Your earnings per share in FY13 was 14 and a half rupees, 14.6, and your book was, I think, 76 or thereabouts. Most of the analysts reports I read are factoring in 20% growth on earnings. Is that a fair assessment, and the book as well?
As I said, there are only three things which goes into our earnings. One, of course, the lending rate, forget, but the borrowing cost, the quality of asset. And as far as the margins are concerned, or the net interest margins, I have already answered saying that we are not going to absorb that totally. And as far as quality is concerned, again, my answer is we don't see a substantial dip to the quality. Again, quality of asset, one must understand, apart from the market behavior, also is an outcome of the loan to asset value. And to chase growth, we have not kind of ever increased our loan to asset value. It's remained around 70-72% levels. So when a borrower has invested 25-30%, I think his own personal efforts to ensure that he's successful is very, very high, apart from market supporting it. So if quality of asset is well maintained, if net interest margins are not given up, and if the growth rates are maintained at 15-20% level, I may not want to put a number out, but we are not seeing huge pressure on the margin front.
All right, Mr. Iyer, we'll leave it at that. Thanks very much for joining in. So that's the view coming in from M&M Financial.